Everywhere we look in 2025, the market appears green, but unfortunately one sector has been left behind, and that is healthcare. While the market is up now nearly 15% year to date, with tech stocks up 20%, financials almost 16%, communication services almost 30%, healthcare is only up 1%, and that's actually after a rally we've seen in the last few months. Previously, they were the only sector in the red. So what's going on with the healthcare sector? Well, this is a chart I shared about a month ago, and it's really telling exactly what's going on within the S&P 500 by sector. For example, we can see if we look at information tech, it's currently trading in its 95th percentile when it comes to the current PE ratio over the last decade. So it's at its near peak valuation over the last decade, and there's other sectors like this as well, such as industrials, such as consumer staples. And in fact, even the S&P 500 is trading at its 87th percentile over the last decade. These sectors in the S&P 500 are trading at multiples much higher than they typically do on average. But that's not true for healthcare. Healthcare is trading at about its 39th percentile, maybe a little bit higher after it's climbed over the last month, but still below the average. Now, for complete transparency, like always, I do own some healthcare in my personal portfolio, but it's relatively small. You can see right now it only makes up a little over 5% in my personal portfolio. But what makes the healthcare industry so interesting right now is how many different stories are being told at the same time. For example, I've been covering these 5 stocks a little bit more frequently on the channel: United Health Group, AbbVie, Merck, Eli Lilly, and Novo Nordisk. And what's going on with each of these stocks is completely different from each other. Now, right from the get-go, we can see only one of these stocks is positive year to date, and that's going to be AbbVie. And what's so ironic about that is their current PE ratio is 106.87. That is an outrageous looking PE ratio. But as we'll see, these numbers aren't always telling the whole story. In fact, a stock like Merck trading at a PE ratio, the lowest PE ratio of these 5 stocks of 12.39, still might not be the most attractive opportunity. Now, on top of this, we can see all 5 of these stocks have grown dividends at a very healthy rate, with even Eli Lilly and United Health Group growing it at about 15% on a compounded annual growth rate basis over the last 5 years. All 5 of these stocks have double-digit return on invested capital, and the gross profit ratios look very attractive. Now, keep in mind, UNH is a little bit different because it's technically a health insurance company, so the profitability ratios will be a little bit lower. So in this video, we're going to do an update on all 5 of these healthcare stocks, and look at the story behind each of them that is driving these numbers and determine which are actually the best opportunities. So let's go ahead and dive in. Now, we'll start with United Health Group. This is obviously the stock that everybody's been talking about over the last few months, and there's a few different reasons. Now, to start in the last year, down 40%. Year to date, down 32.5%. And if you've been keeping up with the stock, you already know why this is the case. There has been just a plethora of bad news surrounding this company over the last year and a half. It started with a massive cyber attack in 2024, which led to a one-time drop in earnings. Look at United Health Group EPS. It was growing very steadily at a high rate for the past decade, and that cyber attack really took a toll, going from $24.12 all the way down to $15.64. But the good news was, at that point, they expected this to recover, but unfortunately for them, the bad news continued to roll in. We have the DOJ antitrust probe, we have the news with CEO Brian Thompson, the disastrous Q1 earnings and lowered guidance, and then of course the criminal fraud investigation, which really pushed down this stock. Now, there's been a lot that's happened in the last few months though, and really it all has to do with the guidance the company is giving us and sentiment around the stock. For example, look in the last month. The stock is now up nearly 11%, going from around $300 per share to at one point as high as around $360, now trading at $341. And keep in mind, even at current prices, if we look at UNH, we can see right now their starting dividend yield is about 2.53%, and that puts it at a much higher starting dividend yield than the company has historically had. You can see right here with the recent sell-off, that yield much higher than the last 5 and 10 years on average. Now, from a fundamental standpoint, even with the run-up in the last month, in the last 2 or 3 months, this stock is still undeniably undervalued, and the numbers prove that's clear. But before we move on, I'd like to say thank you to Moomoo for sponsoring this video. Since we're looking at United Health Group, let's go ahead and add them to our Moomoo dividend watch list and get more insights into this stock. Adding them to our watch list is simple. We just search for the stock and then click to add to our dividend watch list. Now that we've done that, we can see all of the relevant news surrounding United Health Group over the last few weeks. But if we go over to the company tab, we can get way more insights. For example, if we go over to the earnings hub, we can see whether or not they're meeting expectations. We can also see analyst estimates and price targets. Right now, it looks like they're getting a strong buy rating. And now we can also look at United Health Group's historical valuation. How have they traded historically, and how are they trading compared to their industry peers? And if we look at the financial estimates from S&P Global, we can see things seem to be trending in the right direction. If we look at insider activity, we can see there's currently 16 versus 6 bearish insiders. And so if you decided you were interested, Moomoo makes it very easy to actually place this trade. And for a limited time, you can actually get an 8.1% APY on your uninvested cash for the first 3 months. And you can also get anywhere from $20 of NVIDIA stock all the way up to $1,000 depending on how much you deposit. So be sure to check out Moomoo at the link in the description. Using the sensitivity model from Ticker Data, one of the cool features is we can automatically import the average analyst EPS estimate into our spreadsheet. And for 2025, the average estimate has them at $16.23. Now, this is good news, obviously, for a few different reasons, but we can already see projections are showing that 2025 EPS should get back on track. It should start growing once again. And for the next few years, 2025 through 2029, the projected EPS CAGR is actually about 16.5%. So we're looking at a rapid recovery according to the average analyst estimate. So let's just assume that on average, these analysts are right for a moment. We'll go with 16.49% to be exact. Now to project total returns, we need our projected PE ratio. Now the average PE ratio over the last decade is about 22.93. It stayed really close to being in that range for the majority of the past decade. But for the trailing 12 months, it's only about 14.59. So let's assume that it gets back to a PE ratio of about 22, just to see what kind of valuation range, what type of total returns we would get. All of a sudden, you can see by 2030, total returns would be about 124%, which is actually not including dividends in this scenario, which would be a compounded return of 14.43%. Even if it trades at a much lower multiple, you can still see we're getting market-beating returns compared to historic average market returns. This is why people are so interested in the stock right now. Just purely looking at the numbers, there's no doubt there's huge opportunity, but there's obviously still a lot of fear due to the DOJ investigation. But we've seen some good news in the recent months. To start off, Warren Buffett, as you probably know, recently initiated a position in this stock, and he's always stated the importance of investing in companies where you can trust management. So he seems to be trusting of management that the DOJ won't find anything. On top of this, UNH has seen more congressional members buying than selling for the first time in years. UNH was also the #1 most frequently bought stock by super investors last quarter. That's something that I track over on Dividendology.com. And then finally, insiders have bought more shares in 2025 than they bought from 2007 to 2024 combined, and it's a significant amount more. So yes, there's absolutely risk when it comes to the DOJ and the investigation, but the big money is certainly moving into United Health Group, and there's no doubt if they don't find anything, the returns look very attractive. This is another scenario where the numbers don't paint the full picture. 5-year EPS CAGR is obviously a little bit misguided because, as we saw, they had the one-time drop in EPS. This is why it's important to look at it on a year-over-year basis. We can see the current PE ratio significantly lower, again, because of fear in the market. UNH is certainly a very interesting stock to keep up with, but let's move on. Now let's move on and talk about AbbVie. And this is an interesting one because look at the 5-year EPS CAGR, negative 14.65%. Negative earnings growth. Look at the PE ratio, 106.87. That looks like a ridiculous valuation, especially for a stock that seemingly looks like it has negative earnings growth. But despite this, the stock is up over 24% year to date, up over 56% over the last 3 years, not including dividends, which historically speaking, they've paid out a lot in dividends. The starting yield right now is about 2.9%, combined with pretty decent dividend growth. So what's going on with AbbVie? Again, this is a stock that's up in the last year, and if we look in the last month, it's actually taken a little bit of a bump, up about 6.3% right now. If we go ahead and jump over to our stock screener, let's look at AbbVie. And all of a sudden, we can see why the PE ratio looks the way it does. Look at earnings from 2021 and 2022. It was pretty solid. It was record-breaking years, but then we saw a drastic decline in 2023 and 2024, all the way down to $2.40, which was the lowest year of earnings since 2014. So is this a reason to be very frightened of this stock? Is this trend going to continue? Now, we have to remember, AbbVie's fundamentally different in the way that it operates from United Health Group. United Health Group, this is an insurance stock for the most part. AbbVie, this is a pharmaceutical company. And remember, the key word when we talk about pharmaceutical stocks is always going to be pipeline. What is in the company's pipeline? What are the upcoming drugs that they have that could drive future potential earnings growth? So if you go over to their investors presentation, they give pipeline updates and they let you know what's in phase 1, phase 2, phase 3, what's been submitted. And there's a lot to break down here, but if you start digging into things deeper, you're going to see exactly the information you need. Here's the long-term guidance that they're giving. And without going into details on each of these, here's what you need to know. AbbVie's Humira patent expired in January of 2023, and that's what led to a huge collapse in earnings, and it's why earnings has been so low over the last couple of years. But here's the good news. In AbbVie's pipeline, they're expecting Skyrizi and Rinvoq to generate $27 billion of revenue by the year 2027. For reference, if we jump over to the profitability sheet and look at AbbVie, we can see for reference in 2024, AbbVie did about $56 billion in revenue, and it had actually been relatively stagnant over the last few years, at least since around 2021. So this is huge projected growth for AbbVie. And this is a huge reason why sometimes the numbers don't tell the whole story, especially when it comes to pharmaceutical style stocks. Yes, the PE ratio is just outrageous right now, because earnings are temporarily deflated. 2024 EPS is $2.40, but it's clear revenue and earnings are about to get a massive jump at least by the year 2027, and the market is trying to price it accordingly. And on top of this, you get a nice starting dividend yield combined with historical dividend growth that should be able to keep up with the way revenues are about to be growing. If we just glance at our sensitivity analysis, let's look at AbbVie. And you can already see if we look at those average analyst estimates, by the year 2025, this year, EPS is estimated to be $12.03, up 400% from where it was in 2024. So a record-breaking year. 2026, 27, 28, and 29, still projecting solid earnings growth. So about a 12% EPS CAGR from 2025 to 2029. So let's apply that again and see what numbers we come up with. Now, projecting a PE ratio for a stock like this is where it gets difficult because look how wide the PE valuation range has been. And again, it's easy to see why. It's because earnings have fluctuated up and down so much. So what's a reasonable PE ratio for AbbVie? Again, that's where things get a little bit difficult, but let's assume maybe they level out at about the 19 level. Again, it's certainly possible it could be higher, but even with a 19 PE ratio, you can still see we're looking at attractive valuations through 2029 and 2030. Now let's take a moment to talk about Merck. Merck is the stock with the lowest PE valuation ratio on this list, currently sitting at just 12.39. Also, it's been growing earnings at a high rate. 5-year EPS CAGR of nearly 12%. That's higher than Eli Lilly, AbbVie, and even United Health Group. They're also the stock with the highest yield on this list at above 4%, so a relatively medium to high starting dividend yield. Yet in the last year, we can see they're down about 31.2%. Year to date, down about 19%. If we look at those dividend metrics, again, the starting dividend yield is high at 4%. Historical dividend growth. They've been growing dividends for a while now, and the free cash flow payout ratio even looks attractive at about 43%. If we jump over to our stock screener, let's come over here and look at Merck. What we can see is, yes, there's a huge drop in earnings in 2023, but the trend line we're seeing is positive growth. In fact, 2024 was its highest year of earnings at $6.76. But again, we have to remember what type of stock this is. This is another pharmaceutical company. So again, what's the key word? The key word is pipeline. What is in the company's pipeline? And you can dig through this information if you want. They have it linked on their investors' website, but here's the huge concern that's not really addressed in the pipeline. Merck's key drug over the last few years has been Keytruda. It's been a major driver of its earnings growth. In fact, Keytruda was driving around 46% of their total revenue. Nearly half of the revenue they brought in 2024 was from one drug, Keytruda. And here's the huge problem. The Keytruda patent expires in 2028. So yes, even though revenue's been growing, earnings have been growing, and margins have been expanding, look at what happens in the year 2027, 28, and 29 if we look at the projected earnings growth for this stock. If we take a zoom in and take a closer look here, you can see 2025, 26, 27, EPS is projected to grow, but then after 2028, we're looking at negative EPS growth rate projections. In fact, if you look at it on a compounded annual growth rate basis from 2025 to 2029, the projected EPS CAGR is now just 1.83%. Now, here's the reality when it comes to pharmaceutical stocks, specifically stocks that are kind of in the situation that Merck is in. We still have about 2 to 3 years before 2028 hits. A lot can change during that time period. Are they going to pursue meaningful mergers or acquisitions? Could they develop a new drug that completely changes their pipeline? It's really hard to say at this point. And so this is a situation where, in my opinion, it doesn't even make sense to run a valuation. Because the situation is clear. They have a major problem after the year 2027 when they lose that Keytruda patent. If something doesn't change in the next few years that could stimulate growth, the company is in a huge problem. Now, not all investors are the same, but for me personally, I like to invest in companies that have a high predictability when it comes to their earnings and revenue. And for the most part, those are the types of companies that trade at a premium. Think of a stock like Costco that has nearly 93% retention when it comes to its membership. The end result of that is the stock trades at a premium because there's such a high level of predictability when it comes to its future revenues and future earnings. Now, does it deserve to trade at as high of a premium as it trades now? That's a topic for another video, but you get the point. Now, finally, we come to Eli Lilly and Novo Nordisk, and the numbers couldn't look more different. In the last 5 years, the EPS CAGR for Eli Lilly is 6.24%, which isn't terrible compared to some of these other companies, but Novo Nordisk is sitting at about 40.78%. But despite this, the PE ratio for Eli Lilly is nearing 50 and Novo Nordisk just around 15.4. So why is this the case? And why has Eli Lilly outperformed Novo Nordisk by such a wide margin? And will that continue to be the case? Well, there's a reason we're talking about these two stocks at the same time, because they're operating in a very similar market, and in reality, they're in the middle of a huge battle for what's known as the GLP-1 market. And in this market, there is massive growth projections through the year 2030 and beyond. In fact, this most recent data point that I saw is showing it could be around a 26% compounded annual growth rate. So let's just look at our stock comparison sheet. We'll look at Eli Lilly, and then we'll look at Novo Nordisk in their home country ticker. Now, the data will load in and we can compare the two, but let's remove this outlier data point real quick so we can get a more accurate representation of the valuation. We can see the returns have been fairly similar, but Eli Lilly certainly outperformed year to date because Novo Nordisk has dropped by such a large amount. If we come down here and look at the dividend metrics, we can see Novo Nordisk is yielding a little bit more. They've grown dividends at a high rate over the last 5 and 10 years, and the payout ratios look a little bit funny. Why is the free cash flow payout ratio for Eli Lilly over 1,000%? Well, we'll get to that in just a moment. But let's talk about the valuations for these two stocks right now. We can see right now, Eli Lilly trading at a considerably higher valuation multiple with the PE ratio compared to Novo Nordisk, whose valuation multiple has dropped relatively low. Right now, if we look at it as of 2024, it's 27.5, but for the trailing 12 months over here, 15.34. Well, again, it boils down to the expectations with the GLP-1 market. While Novo Nordisk has a majority market share, Eli Lilly has been, at least over the last year, expected to significantly cut into that. And if we look at the projected 4-year EPS CAGRs, Eli Lilly is sitting at 20.11, while Novo Nordisk is about 9.68%. But we had breaking news actually last week for Novo Nordisk that could certainly change things considerably. Novo Nordisk's Wegovy pill delivers 16.6% weight loss in people with obesity. This is a very big deal in this battle that they're in with Eli Lilly, and if this is approved by the FDA, the pill for weight management will be fully made in the US with production already underway at Novo Nordisk's significantly expanded manufacturing facility. So I would not be surprised whatsoever if we start to see EPS growth rate projections for Novo Nordisk start to bump up in the coming weeks. Now, when it comes to free cash flow and Eli Lilly, if we look at the dividend sheet, what we really want to point out is the negative free cash flow in 2023, and then 2024 they got back to positive, but the free cash flow payout ratio over 1,000% because the amount they paid out in dividends was about $4.6 billion, while free cash flow was only $414 million. Why is this the case? Well, Eli Lilly has been making heavy investments to be able to take advantage of the exploding GLP-1 market. And analysts seem to think they're going to be able to do exactly that, as we just saw with the projected 4-year EPS CAGR at about 20%. In fact, if we just look at Eli Lilly on our PE sensitivity model, one of the things we can see is if we come down here, EPS by 2029 projected to be $47.53. Last year, it was just $11.76. Look at this, in 2025, projected to come in at $22.83. We're essentially looking at a double in 1 year. So again, this is another situation for both of these stocks in reality where the numbers definitely don't paint the full picture. Eli Lilly is priced the way it is because there's massive growth potential when it comes to earnings over the next 5 years. At the same time, Novo Nordisk is being valued at an interesting price point because of fears of Eli Lilly taking market share, but again, this battle keeps going back and forth, and we saw the good news with Novo Nordisk last week. So there's a few points we need to make here. There's a lot going on in the healthcare sector, and the reason we see the healthcare sector down so far year to date is not due to just sector weakness in general. Maybe there's a little bit of that, but each of these companies has a very unique story going on right now. Whether it's high valuations like Eli Lilly and AbbVie, but potentially justified, or if it's like UNH where there's investigations. And then we have scenarios where there's companies like Merck, where there's serious concerns about losing some patents in the coming years, and Novo Nordisk, who might lose market share to Eli Lilly. The reality is there's a lot of uncertainty in the healthcare sector right now, but there probably is some opportunity as well. With that being said, like I mentioned earlier, there's a lot less predictability in the healthcare sector. So again, while I do own some healthcare in my personal portfolio, it's currently only about 5%. I much prefer stocks that have very predictable cash flows. So there you go. Those are 5 interesting healthcare stocks right now and why they're priced the way they are as of right now. Go ahead and let me know what you think of these companies in the comments down below. And again, like always, if you'd like to download any of my spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.